The following program is an interview and discussion whose sole purpose was to better understand, from a cultural perspective, an unprecedented and what may prove to be historic situation as it was unfolding. Neither the producer, nor the host, nor the guest are financial services professionals. Nothing in this episode should be interpreted as investment advice. No investment decision should be made from listening to the content of this program. Listeners should always practice their own careful due diligence before making any investment decision. You're listening to Interview Time. At 11:57 a.m. on Wednesday, February 24th, 6 days after the House Committee on Financial Services held a public hearing on the GameStop trade, activist GameStop investor Ryan Cohen tweeted a cryptic photo of a McDonald's soft-serve ice cream cone with a frog emoji. The stock price jumped from $44.70 to $91.71 a share, and $30 million worth of trades happened in the final hour of the market that day. On Thursday the 25th, the stock soared to a daily high of $183 a share, and 145 million shares were exchanged in the heaviest day of trading since January 26th. Within 24 hours of Cohen's tweet, GameStop had gained roughly $4.4 billion in value. My guest, philosopher Justin Horn, returns to discuss the evolution of the GameStop trade, the fallout from the congressional hearings, the real meaning of Cohen's ice cream cone, and how social media and newfound accessibility for retail investors is creating a disruptive era of volatility and opportunity in the stock market. Justin Horn, welcome back to Interview Time.
It is my pleasure to be back with you once again.
At the time of this recording, GameStop is at $120 a share. Do you still hold a position in GameStop?
You better believe I do.
Why?
As I said in our last interview, I was of the opinion that the rise in price that we saw before there was not due to a short squeeze, as many news pieces in the media have suggested. Instead, I think that rise in price was a combination of some gamma squeeze action, that is, option makers purchasing more shares to hedge against the potential that they will have to deliver on exercised options that come into the money, combined with retail excitement about the stock generated through social media and the obvious spotlight that GameStop received as its price started to rise dramatically.
With that in mind, going through February, the stock price, it at the end of January had hit a high, I think, of $438, and then had plummeted down to about, I think it was in the $40 range.
Yeah, 483, I believe, was the high, and down to prices below $40. I think I saw 38 at one point there in our 3-week walk in the desert.
Did you ever think at the time, like, maybe the squeeze had been squoze already?
Obviously, you're going to do some questioning after you have watched unrealized profits of 90% of your position evaporate and see the price maintain, in that level for weeks. Yeah, of course, I asked myself, as I'm sure many holders of the stock did, it's like, was this all a big mistake? Was I fooling myself? Maybe, is it possible that the shorts really did cover their positions somehow, and that this was all, that I've fooled myself somehow in making this particular investment play? Yeah, I asked myself those questions, sure. However, the answers that I all came back to is that I personally saw evidence of, a lot of Wall Street connected media publications pushing out articles, very negative sentiment on GameStop.
When you say towards GameStop, do you mean GameStop Corporation itself or the GameStop situation, or both, I guess?
Mostly focused on the stock rather than the company. Any mentions of the company were generally in service of advising retail traders to stay away from this stock. It's dangerous. And I will say this, look, if you don't know what's going on with GameStop and you're just seeing the price rising up and you're just going to jump on and think, well, everybody's making the price go up, and so I should jump in and get in on some of that price action, and then I'll sell it off higher. Like, don't do that. don't do that. Please, for everyone's sake, including your own, don't make investment decisions with your money that you don't understand. Am I telling people not to buy GameStop? Absolutely not. I'm just saying understand what you're doing and what you're getting into before you make any decisions. And again, I'm long on GameStop. I did not sell one single share since I've last talked to you or since we were at the high. And I've actually increased my position since then because I had call options expiring in the money last Friday. And I exercised an option. I now hold 100 more shares than I did before. But again, I've been following the story and the situation on the GameStop stock with laser focus since November. Well, not with laser focus since November, but I've been following it since November and very keenly focused on it since January. Given the theses I have about the stock, mostly regarding the fact that I do not believe that the shorts have covered their positions, despite their repeated insistence in multiple media articles.
Yeah.
And in fact, I think we had data come out that shows that Melvin Capital and I believe Citadel and a number of other hedge funds do have very sizable positions in options, at least, that are short on GameStop. Now, that's different from having short shares borrowed, but it definitely suggests that they do still have a strong belief that the stock is going to be at a lower price point in the future.
So they still think someday this is all going to die down and the short sell is going to work. Is that what you're saying, or are you saying something else?
Well, I'm not going to, I can't comment with any certainty.
Certainly not.
About what positions the hedge funds have.
Sure.
And those put options that, were the focus of one of many Reddit posts on this today. And, there are, dozens of them every day that, that get released on both WallStreetBets and the newly created GME subreddit.
What is going on with this new GME subreddit?
As I suggested last time, maybe a little bit less strongly because I was less sure about it at that point, that I thought that perhaps the hedge funds that were short on GameStop were using every tool in their arsenal to convince people not to buy it and to sell what they were holding to get them out of their bind that they're in if they do indeed still have short positions on GameStop. And I'm more confident now than I was then that they do. And among the techniques that I think that they've used over the past couple of weeks is to spread negative sentiment with hired accounts in the WallStreetBets subreddit, and that's been going on for weeks. Can I prove this beyond, with absolute certainty? No, but I do have a habit of when I see posts or comments from Reddit users that seem like they might be fear, uncertainty, and doubt-based comments or posts, I will click on the user and look at how old the Reddit account is and go into their comment history and just kind of take a look and see what I'm seeing. And
what are you seeing?
Well, I see a lot of new accounts, and I see a lot of accounts that have been totally inactive for over a year, suddenly coming back and commenting furiously about why people should get out of GameStop stock investments. And that seemed suspicious to me. And it, they weren't all like that. There were some negative comments from who were clearly real Reddit users and active Reddit users. And it's worth noting that at the congressional hearings, the CEO of Reddit said that their investigation found that there was no evidence of bots or fake accounts being used. But I did find it interesting that many of these same accounts that were commenting negatively about GameStop were also ones pushing all these other meme stocks that the media then would pick up stories about these other stocks and how Reddit users are pushing this now, and that like they're finished with GameStop and on to the next big squeeze.
So is that something that you actually looked into? You've seen, let's say, an account on Reddit, and it's pushing maybe another meme stock, and you went in there and you clicked in and you saw like, oh wow, like that hasn't been active for a couple of years, and now all of a sudden it's excited about.
Yes.
This.
And the other thing that I've been tracking these meme stocks as well. I haven't been invested in them because as I said, I suspect that all of the fervor around these other stocks is, if not entirely generated by, at least largely amplified by Reddit users either directly working for the hedge funds or contracted by them to come in and push these other issues. And because one, it paints the users of WallStreetBets in a kind of a bad light, and because all of these other meme stocks have looked like pump and dump schemes where somebody hypes up the stock and the retail investors get excited and everybody jumps in, and then all of a sudden it just crashes right back down again, and a lot of retail investors get left holding the bag.
And it reinforces the narrative out there that these, like what you just said, but it reinforces the narrative out here. Like, you see, like it's a pump and dump scheme. There's no fundamentals here. There's no pump and dumps. But I know that you believe that GameStop is different. It's not totally different.
This is, in my opinion, a unique, probably once in a lifetime event, and an ongoing once in a lifetime event. And it's this perfect storm, and all of those other ones are, pretenders when you compare them against the situation in GME. And I think that all of those have been actively pushed by people who do not want to see the GME short squeeze succeed.
So because of that, and because there's suspicion of sort of foul play, is that what has now pushed people over to this GME subreddit, this new GME subreddit?
Yeah, that's, I think, was the sort of impetus behind its creation, because WallStreetBets was just getting flooded with these people just, mocking anyone who would post anything about GME and pushing all of these other, what I take to be pump and dump schemes. And there have been no shortage of them. To any folks invested in these companies, this is just my opinion. And if you believe in your investment theses with regard to those companies, that's great. I wish you luck. But insofar as I think that they're, kind of part of a team with GameStop, I think that is exactly what the people who don't want the GameStop short squeeze to succeed would like to see happen. And you had AMC, you had BlackBerry, Nokia, you had all of the weed stocks, the marijuana stocks. That was a big thing and they jumped up crazy amounts for like a day or two, and then came crashing back down again, presumably to the lining the pockets of the folks on Wall Street who are, tempting people into these other sort of, here's another get rich quick vehicle.
Right.
And then there was that's the silver squeeze, that Reddit users are trying to manipulate the silver prices. And most recently, as of this morning, it's Rocket Mortgage. Rocket Mortgage jumped by 70% today. And I think I saw it mentioned on WallStreetBets once since I've started following that subreddit in the last year. Again, maybe there was a whole Rocket Mortgage thing going on for a long time. I just missed it, but that was not my impression. And I think that's just the next one in line after all of these other schemes that these folks have tried to attract attention away from GME to these other stocks. But the really notable thing about it is how quickly the Reddit communities that are pro GME, like they'd sniff this out easily. And you also have, wherever you see these guys in the comment threads or posting stuff, you have tons of GME people just calling them out, like get out of here with this. You're trying to trick me, and you clearly want me to get away from GME and into this other stuff, and it's not going to work. I'm holding my GME shares, and better luck next time. Try again, hedgies.
And you brought up something last time that I thought was kind of interesting, and you said that in a sense too that WallStreetBets pulled off this incredible GameStop situation. It was pulled off. It's a once in a lifetime opportunity, but now they've given away their position. Like, if you thought about this as a
battle,
a war or a battle, which some people certainly do, now the enemy knows where you are, and maybe now they're breaking off. The really hardcore GME investors have kind of their own safer space now to talk about it or something.
Well, and it's even there's no safe haven, right? I mean, because like now you're starting to see the same thing happen in the GME subreddit, and I mean there are people coming in there in the last 24 hours posting all these posts about Rocket and how you get into Rocket. You want to go to the moon. Well, this is Rocket, so get on it.
It's called a rocket.
Hey, the meme temptation is strong. I hear you, but it's like, and people in the subreddit are like, dude, this is a GameStop subreddit. It's in the name of the why are you coming in here talking about other stocks in the GameStop subreddit? Like, unless you really, really want us to not pay attention to GameStop and look at something else. and all of that just further confirms my thesis that these guys wouldn't be doing this stuff. You wouldn't see this amount of negative attention on GameStop and all of this effort to convince people that for your own safety, please, we're begging you, sell the stock before it's too late. You might lose even more money. And it's like, come on, dude.
It is also kind of illuminating though, because of there's really like a sense of a conflict going on because the stakes are so high.
The stakes are very high.
People are resorting to, tactics like disinformation campaigns, and it's all being waged in the stock market. And I'm not a historian of the stock market by any stretch of the imagination, but I wonder if this is a somewhat unique situation.
I believe that it is, and I'm no expert historian of the stock market either, but given the facts surrounding this particular potential short squeeze, and I'd like to point out once again that you said like that in our last interview, I may have said like they've pulled off the a great coup in doing this, but even though that will remain true no matter what happens from here on out, it remains the case that the short squeeze has not been squoze, as they like to say on Reddit.
I wanted to talk about a couple of key dates that have occurred. The last time we talked on after, there was the key date of January 29th when Robinhood restricted the buying of GameStop shares for a day. And then there were, of course, congressional hearings called. So on February 18th, the House Committee on Financial Services held public hearings on the GameStop trades. Gabe Plotkin from Melvin Capital, Ken Griffin from Citadel, Vlad Tenev from Robinhood, and Keith Gill, a.k.a. Deep Fucking Value from WallStreetBets, all testified about their different roles in the trade. And I wanted to ask you, because you are someone who has followed this story with a laser-like focus, do you think we learned anything new in these hearings, or was it just a elaborate political theater?
I think you can always learn something new from paying attention to what's going on. So for one, I really enjoyed watching that hearing. That was the most entertaining congressional hearing I have ever seen by far. And I'll also mention, sort of in a broad conclusions, it does seem that the general tenor of the folks on the Congress side of that hearing, obviously many of whom disagree with each other about a lot of other things. It was really interesting to see a great deal of sort of bipartisanship in support of retail investors, and sort of also a bipartisan ire at the brokers like Robinhood that suspended trading, and the hedge funds like Citadel who were short on the stock, and like Melvin Capital. So did we learn anything new? I think we did. For one, Gabe Plotkin, in his testimony at one point, suggested, as I did earlier in this interview, that the rise in price in January was not due to shorts covering. It was due to options, gamma squeeze action, market makers hedging their call options coming into the money, and increased media attention through social media, driving higher levels of retail buying. So that's pretty much saying that that was not a short squeeze. It was maybe a gamma squeeze and some hype, but it was not the short squeeze that the mainstream media then went on to report for the next couple of weeks.
So it was proof that the squeeze had not been squoze.
Evidence.
Strong evidence. The squeeze had not been squoze.
It was evidence, at least, that Melvin Capital did not believe that the squeeze had been squeezed.
What did you think about Deep fucking Value's testimony?
I thought his testimony was fantastic, and I'll say that I'm not neutral towards Keith Gill, Deep fucking Value, or Roaring Kitty, however you want to call him. Especially after watching that hearing, you can't help but love this guy. I mean, he is just such a lovable character in this GameStop drama. And I thought that his prepared remarks were excellent in basically pointing out that he is not trying to manipulate anyone. He's not trying to manipulate the stock prices. He's not trying to give financial advice to anyone or investing advice to anyone. All he did was take a long position in GameStop over a year and a half ago, buying a lot of shares of GameStop and call options in GameStop expiring long term, and maintain that position, and occasionally discuss his thoughts about the company and its future, which he thinks is bright, on a variety of social media platforms, as you know, lots of people do. And just like lots of people, you might talk with their friends about what stocks they're investing in or what they like, and just trading ideas in a public forum, discussing what companies they like and what they want to invest in. And he's exactly right that is exactly what he's done. And anybody that's trying to suggest otherwise, I would advise you to raise an eyebrow at that, because this guy's clearly done nothing wrong except be very, very, very right about the undervaluation of GameStop's stock price. Also, he, has kind of given some nods to his many, many fans on WallStreetBets, opening his statement with a reference to the recent "I am not a cat" meme of the lawyer in court who forgot to turn off his Zoom filter and looked like a cat. He made reference to that in the
and his YouTube name is Roaring Kitty.
And his YouTube name is Roaring Kitty, so it was entirely topically appropriate.
And there was a picture of a cat hanging on a rope, and it said "Hang in there" on the whiteboard
Hang
behind
in
him
there.
as well. Yeah. I would just say that I was struck by his testimony because it was so well thought out. It was clear. And then the other thing I would say, in contrast to pretty much everybody else on the day, it was authentic and it was straightforward. And he was just
stark contrast to
stark.
everyone else.
And then then
interviewed.
you watch every single other person get interviewed. Maybe not so much the Reddit.
The Reddit guy, he
was
didn't
fine, but it was
like
very polished. It was
Yeah.
very it's a polish. He was the only one who had depth of field photography going on. The Reddit
CEO.
CEO.
And whoever the gal was from the Cato Institute, who was sort of our resident market expert, right? And
but if I think that in terms, if we were going to say that this was political theater, which is not necessarily a bad thing, I think that the big star of the show that night was probably Keith Gill, and it's because he came out and he just was speaking perfectly straightforward. He was telling the truth. He had the demeanor of someone who has absolutely nothing to hide. And then it was just really kind of powerful to then see everybody else just evasive, squirming, uncomfortable,
clearly reading off of teleprompters, clearly stalling for time and trying to eat up the question time so they could avoid the questions. And that's pretty common at congressional hearings, I think, sometimes, but it really did stand in stark contrast to Gill's testimony, in which he seemed authentic and a deeply convinced believer in a bullish future for GameStop. And on that note, one of the congressmen interviewing Mr. Gill asked him.
Okay, so actually the business channels had a good question from one of the Reddit readers, which is, so you recommended GameStop before. Would you buy their stock now at roughly 45? It started at 48 earlier today. You were talking about buying it and being happy when it hit cross 20. So are you buying that stock today?
Well, let me just say that investing can be risky, and my particular approach to investing is rather aggressive and may not be suitable for anyone else. But for me personally, yes.
So yes or no, are you buying the stock? And
for me personally, yes, I do find it's an attractive investment at this price point.
And you could see that it seemed like the Senator Huizinga was trying to get Keith Gill in kind of a gotcha moment there, and was expecting him probably to squirm a little bit and say that he was kind of feeling uncomfortable about really being committed to the stock still being a good buy at these levels. But anyone watching that interview would have no doubt that Keith Gill was being 100% truthful there and saying, yeah, he really does think that the stock at these levels is still underpriced and would buy it today at these levels. And went on the following day to double down on his GameStop share position. He had, prior to the congressional interview, held 50,000 shares of GameStop stock. And the following day, after the market closed on Friday, he posted an update to his GME YOLO ongoing position posts over time. And the screenshot that he shared showed that instead of 50,000 shares, as he had in his last update, he now had 100,000 shares. Now that's approximately $2 million worth of GameStop stock that he bought into, and Reddit went nuts.
It was very interesting just on a human level to see Keith Gill, who, you're talking about kind of an everyman figure, sit in front of Congress, which would be, if somebody called me to testify before Congress, I would be absolutely petrified. And he sat there with poise and dignity and authenticity and told his story, and he had nothing to hide, in stark contrast to Vlad Tenev, who had his defining moment a couple weeks earlier. Well, how did you think Vlad Tenev? I wanted to ask you about one comment he made, because they asked him straight up,
why did Robinhood restrict the buying but not the selling of GameStop? And why did folks get locked out on the buy side only?
Ranking Member McHenry, I appreciate the opportunity to address that. The reason that Robinhood, first of all, let me say Robinhood is always committed to providing access. It's in our name. It's in everything that we do. The decision to restrict GameStop and other securities was driven purely by deposit and collateral requirements imposed by our clearinghouses. So buying securities increases our collateral requirements. Selling does not. Moreover, preventing customers from selling is a very difficult and painful experience where customers are unable to access their money. So we don't want to impose that type of experience on our customers unless we have no other choice. And even though I recognize customers were very upset and disappointed that we had to do this, I imagine it would have been significantly worse if we prevented customers from selling.
Let's be crystal clear. That decision you made to restrict the buying but not the selling of GameStop was based on pressure from anyone on the witness panel here today?
Not at all. Zero pressure from anyone. It was a collateral depository requirement decision made by our Robinhood Securities president.
If I understand the situation correctly from what I saw in the congressional hearing, Vlad Tenev's argument was that my hands were tied. I had no choice but to do these things because the DTCC came to me in the middle of the night and said, you are undercapitalized and you're at big risk, and we're going to start liquidating your assets if you don't come up with enough money to be properly capitalized for the risk that you're at here. It also, from his testimony, emerged that either him or his team had some kind of a discussion with the DTCC, and they decided that he could have lower capital requirements.
I think they went from something like $3 billion, and then it
down
landed finally at
$700
million. And I think that decision came after he said that he would restrict buying.
Right. The 700 million capital requirement was, came with a caveat that, we can set it at 7 million or 700 million if you don't allow retailer users to purchase any more shares of that stock. And I'd be interested to know whose idea that was, especially because it seems to me that if I also understand this correctly, that if a short squeeze happens and buyers in short positions are forced to buy at market prices, ever increasing to perhaps ludicrous levels high enough that their debt bankrupts the people who are short on it, the hedge funds that are short on GameStop, and their debt exceeds the total of their assets. Well, what happens then? As I understand it, the responsibility for covering that debt then goes to the clearinghouse, who then has to pay it. And if they go bankrupt, then the next person in line is the DTCC themselves. The DTCC has a lot of assets, and I believe also a lot of insurance. I'm not absolutely sure on the numbers of their insurance, but I've seen numbers in the tens of trillions of dollars worth of insurance to cover a situation like that. But if somehow the prices if the holders of the stock demanded truly exorbitant and very, very large sums of money and had people forced to buy them, you could see the price go high enough that it could run through those hedge funds and clearinghouses into the DTCC too. And it makes me want to get senators to ask questions about, like, well, how is it that both of these entities who may be on the, because I believe Citadel is Robinhood's clearinghouse, but also their biggest customer, which means if they go down, that's going to be very, very bad for Robinhood's business model.
Yes.
And I'm not sure if Robinhood themselves have any liability.
And I think it's important to point out that Citadel is essentially the reason why Robinhood has commission-free trades, I believe, because they charge companies like Citadel for order flow.
For selling the order flow, right? To sell the information of the retail. Now, it's true that it's illegal for Citadel to trade ahead of traders. They basically have to guarantee that retail traders whose order flow they place will get the best possible price for their trade that can be got.
Right.
I think that there's obvious potential for market makers to use information about retail order flow to make a lot of money. Otherwise, they wouldn't be paying so much money to get it. So I think that's something that Congress ought to look at. But I don't necessarily think that it's definitely a bad thing, because, you know, in Robinhood's defense, that business model has allowed commission-free trading to become a thing, and a thing that is now industry standard, as Vlad Tenev repeatedly tried to emphasize during the hearing, even when that was not the topic of what was supposed to be discussed. So I don't necessarily think payment for order flow is a bad thing, and this is another point I'd like to make about that hearing, is I think that the Congress was focused far too much on the issue of payment for order flow, and not at all enough on the kinds of tactics that can be and have been used by hedge funds in the past in documented cases to engage in naked shorting or disguise or manipulate their short positions in ways to manipulate the appearance of smaller short positions than actually existed when the short data came out. I'll give you an example of this that's been a popular item of discussion on both the WallStreetBets and GME subreddits related to ETFs, exchange traded funds, which contain GameStop as one of their elements. So let's say you wanted to be short on GameStop, but you didn't want people to think that you were short on GameStop. You wanted to be able to tell Congress that you closed out your short position already, and that you're no longer have an open short position on GameStop. Well, let's say you see this ETF over here called XRT, which is like the S&P retail ETF, of which GameStop is a large holding in that. Well, you short a bunch of shares of the ETF, and so you get all these shares, but instead of just directly selling short the ETF shares that you've borrowed directly into the market, instead you take them and you form what's called a creation unit, which is where you gather enough ETF shares to then trade those in for the actual shares of the underlying stock. Okay, so now you've got a short position on this ETF that contains GameStop. You've got all of the underlying stock, and then basically, long story short, you short the ETF, and then you get out of you close the short position with respect to all the other stocks in the ETF except for GameStop. And that way you still have short interest on GameStop, but it's under a different label. And the Redditors, of course, sniffed this out as they sniff out everything.
Yeah.
Those guys are they're the best detective force in the world. I'm telling you, internet Reddit detectives. These guys are just insanely good at sniffing out information that's out there. And in this case, They go and look at the short percentage of XRT, and all of a sudden it's like, oh, look, the short interest on XRT is at 200%, and it's at like way higher levels than any other ETF out there. Weird. So this is one way that hedge funds or people that have taken short positions in the past and done so in ways that, you know, they want to mislead people or conceal information about this stuff that's not by law supposed to be concealed. These are the kinds of questions that Congress needs to be asking. They need to be asking about the failure to deliver rate on closed shorts. When people recall their shares and say, I don't want my shares to be lent for shorting anymore, they're supposed to come up with those shares and return them within 3 days. And if they're not delivered at that time, they then come up as a failure to deliver. And of course, there's going to be some times where just, you know, the mechanics of the world get in the way, and like the people don't return the shares because they didn't get the phone call or something. You know, there's all kinds of reasons that could get in the way. But failure to deliver rates on GameStop have been very, very high over the past year and remain high. And that's another thing I'd like to see Congress focusing on rather than the discussion of payment for order flow, because I think it's much more important to dig into the illegal activity that may be going on. And obviously the SEC has an ongoing investigation into this stuff. We'll see what they come up with. But finding the criminals, in my opinion, is more important than discussing the merits of this legal structure for the stock markets to operate under versus that one. Those conversations are important too. But look, let's get to the bottom of the shenanigans and shady games that are going on, if they are indeed going on. Let's put the focus on that for now, and we'll get to the other stuff after that. That's what I'd like to see personally.
I want to talk about another key moment in this narrative. On Wednesday, February 24th at 10:57 a.m., Ryan Cohen tweets a cryptic photo of a McDonald's soft-serve ice cream cone with a frog emoji. $30 million worth of trades happened in the last hour of trading on Wednesday. 145 million shares were traded on Thursday. That's the heaviest day since January 26th, and almost 3 times more than the average volume over the last month. And within 24 hours, GameStop had gained roughly $4.4 billion in value. What happened? What did the ice cream cone mean?
Well, of course, if someone like Ryan Cohen or anybody sort of centrally involved in this saga tweets something that doesn't have any words and it's just a picture and an emoji, obviously that's going to immediately generate a wealth of speculation about how that's to be interpreted. And I think it's fascinating that you're seeing a lot of people making these kind of tweets, like Keith Gill as well, tweeting just pictures or clips or memes, but not including text and not sort of explicitly making any kind of assertion, just tweeting some image, an emoji, and leaving the interpretation of that to the Twitterverse at large. A lot of people had a variety of suggestions about what that emoji and ice cream cone photo meant. For example, I was reading that somebody noticed that when Ryan Cohen had just had his very first meeting with executives at Chewy.com when he was launching that business, they had a really wonderful, friendly strategy meeting, and at the end of it, they all went to McDonald's and had soft serve ice cream cones, and that this was a sign that Ryan Cohen was, at the helm, behind the scenes, and ready to embark on a new journey with GameStop. And I read elsewhere that the frog emoji was a symbol of metamorphosis, and that the GameStop was undergoing these fundamental changes and evolving into a new form, and that was the significance of the frog emoji. However, the interpretation which I think is, in my opinion, the strongest candidate for what, if anything, Ryan Cohen was intending to indicate or suggest by means of that tweet, makes reference to a technical trading indicator that's commonly used among technical traders. Technical traders are traders who analyze patterns on the price charts of stocks and use those to glean information about forming or changing trends in the stock's price movement in order to profit from finding good entry and exit points for trades. There's a variety of different technical indicators that get used by different traders. You get 10 different traders, you're going to have 10 different answers about their special secret sauce of indicators that they like to use to guide their trading behavior.
Sure.
But interestingly, the more popular an indicator is, the more likely it is that it's going to, give results to you, because as a bunch of people use the same indicator, it turns into a kind of self-fulfilling prophecy that the price moves the way that the people using that indicator expect it to, because so many of them using that indicator join the movement in that direction. One of these indicators that's very commonly used is called the moving average convergence divergence indicator. And this is commonly abbreviated as the MACD, which I believe is what the McDonald soft serve ice cream cone is trying to point at, the MACD indicator. Now, I'm not going to spend a long time explaining the details of the MACD indicator. There's probably a dozen videos on YouTube. You can just search YouTube for MACD indicator or Google it. But in short, you take moving averages of the price of the stock at a short and a long-term view, and you compare the distance on the chart between those two moving averages, and you use that to plot another curve, and then you do some fancy math on that curve to get a fourth curve that you've drawn, and then so you have the MACD, and the fancy math derivative is the signal line. And you plot the MACD and the signal line, and the MACD will typically cross above and below the signal line over time as the price of the stock goes up and down. The way that technical traders use the MACD indicator is that when it crosses above the signal line, that's a buy signal, a good entry point according to the indicator to purchase the underlying security. And then when it crosses below, that is a sell signal telling you to take your profits on your trade and get out and wait for another buy signal to arrive in the MACD indicator. Now, it just so happens that if you look at the chart on GameStop's price movement, so if you look at calculate the MACD on GameStop, it turns out that on that very day that Ryan Cohen tweeted that, the MACD was just about to cross over the signal line, giving a buy signal on GameStop to technical traders using the MACD indicator. And I think that the frog emoji suggests that it was the MACD is leaping over the signal line, because that's what the MACD does. It hops back and forth above and below the signal line. And that is the significance of the frog emoji in this context. Whether that's absolutely correct or not, I can't say with 100% certainty. Only Ryan Cohen probably could give you the answer to that. But that is the only interpretation of that specifically makes sense only on that particular day, the day which Ryan Cohen tweeted it, which was when that signal arrived in the chart.
So right when he tweeted that, or that day, on the MACD chart, the MACD line was leapfrogging above the signal line, which was signaling to technical investors buy.
Yeah, it was confirming the beginning of a new uptrend in the price of the stock.
That's fascinating, and I think that sounds like a pretty remarkable interpretation. I am curious, though. You, of course, I'm assuming didn't put that all together right in those first moments. What were you thinking when you first saw that tweet from Ryan Cohen?
Obviously, I didn't immediately decode that on the spot on the day, but I did recognize that probably that tweet had something to do with GameStop, in particular because he's made tweets before in which he's had a photo paired with an emoji, and other interpretations of those tweets have been most plausibly related to GameStop and Ryan Cohen's growing involvement in its leadership. So I took that as a bullish signal and immediately acted to take up positions which would profit from a rise in GameStop's share price, and I made a fair bit of money that day.
So you interpreted it as a bullish signal.
In particular, I also thought that the rest of the trading world, upon seeing that tweet, whether or not this was correct, would interpret it as a bullish signal on GameStop, thereby driving its price upwards rapidly. Something
happened because it did have a pretty dramatic rise immediately after he tweeted that.
But we also have to be careful about solely attributing the rise in that price movement to the tweet. And a lot of media outlets have done that over the past week, saying that it was this cryptic ice cream cone tweet suddenly made the price jump out of nowhere. It's like, well, that might have contributed. I'm certain it did contribute, at least in part, to the rise in price that day. But let's not forget that the MACD indicator signaling to technical traders that the trend of the price is moving upwards is an objective fact that existed there, whether or not Ryan Cohen made that tweet. And technical traders paying attention to that may have entered that trade just on the basis of that MACD signal on that day, which could have also contributed to the rise in price. And there's it's a complex, complicated, and interconnected world of fast changing facts, any of which could potentially weigh on traders' opinions about that security. So attributing all of this to a single event is probably oversimplification.
Well, there was also another kind of couple of things that also happened, I believe, also on Wednesday, also related to GameStop, also related to Ryan Cohen. One of them was Jim Bell, the CFO, GameStop. It was announced that he would be leaving by March 26th, and it was publicly announced, and it was publicly stated when it was announced that GameStop, and Ryan Cohen was behind all this, is going to be finding someone, a new chief financial officer that's more in line with his vision for the company, which is to pivot it into an online business. That was one major thing that happened at the same time that could affect the stock price.
That's definitely true, and I think that many traders in the GameStop trade also interpreted Jim Bell's departure as a bullish signal for GameStop.
There was also a report released that day from Citron Research, which was recommending that GameStop purchase esports entertainment, which also, I think, signals a change in direction of the company.
Yeah, it's been interesting to see a number of people in the mainstream business world spitballing ideas about how GameStop could transform into the future. Jim Cramer of Mad Money fame suggested that they invest a lot of their corporate treasury into Bitcoin and become a Bitcoin vendor to their customers as well, which was it's creative at least. I don't know if that's the direction that they're going to go in.
Outside the box thinking.
Yeah, but there's a lot of outside the box thinking going on with relation to the future of that company and the opportunities it has to grow into the burgeoning gaming industry.
You said just a few minutes ago, essentially this MACD chart is just stating an objective fact. It's signaling a trend upward to buy. Let's say you're right about what the tweet meant and it was referencing the MACD chart, in which case it's referencing objective information. So if you're right, why do you think Ryan Cohen needs to share trading signals disguised in cryptic memes? Is it just for fun? Is it because it makes it more exciting, or is there some kind of strategic reason for doing that?
I think that there are a lot of very wealthy people and institutions that may stand to lose an enormous amount of money depending on what happens with the future of GameStop's trading action. And those people will lash out at Ryan Cohen, and they will, if they end up losing a lot of money, they will try to accuse Ryan Cohen of market manipulation, and they'll probably try to accuse Keith Gill of market manipulation. For my part, I don't think either of them have engaged in market manipulation of any kind. And even if they came out and just directly, explicitly tweeted, hey, the MACD on GameStop's price chart is giving a buy signal right now. Even if they came out and explicitly said that, I don't think that's market manipulation. That's just an observation of an objective fact.
Right. So why do you have to do it in a meme?
Because they're going to try to accuse him of market manipulation, whether or not that's true. And so what he's doing is limiting his legal liability in that way, because he hasn't come right out and asserted anything, and he's certainly got plausible deniability that that's what indeed he meant by that. And that's going to protect him against lawsuits that he rightly foresees will be filed against him if GameStop causes a lot of rich people on Wall Street to lose an enormous amount of money.
There's been a lot of talk, I'd say, since January. The term meme stock has really entered the mainstream lexicon, and it seems to be something that is sort of instantly understood. How does a meme stock work?
Well, before you can answer that, we got to at least give some kind of a rough idea of what a meme stock is. What makes something count as a meme stock, and what does that even mean? It's probably a question worth answering now that the phrase meme stock has been entered into the congressional record. The concept of a meme goes back to Richard Dawkins, scientist and philosopher who coined the term as a sort of analogy from a gene. So like a gene in your DNA is a sort of a little piece of your DNA that is part of a self-replicating process, and it's got certain characteristics that if a particular gene makes the organism that has that gene better suited to survive, then that gene will replicate more often than competing genes and become, sort of a successful gene and spread throughout the population and survive and thrive. And Richard Dawkins pointed out that there are that pattern of evolutionary competition and replication could also be applied to ideas, and that like a successful idea that is useful or funny or just memorable can spread and thrive and replicate in the medium of people's minds, right? And that successful ideas and little bits of information that have the right characteristics to be popular and spreadable will replicate from one person who has the idea to other people that they share it with, and then other people that they share it with, and so on. And if it's got characteristics that make it the kind of thing that other people share and spread to other people's minds, then those ones will succeed and thrive into the future over their competition. This term then sort of got a little bit changed over time and is now used more colloquially to refer to images with text overlays or videos with text overlays that are just, short little audio visual jokes, basically. But the ones that are successful and are funny get shared and spread around and replicate, and increase in a competitive environment where, you know, the resources that they're competing over is our attention, right? And the things that we think about and spend our time considering and sharing with others. So a meme stock, I guess, is the idea that these people who are on WallStreetBets, for example, or other social media sites, often immortalize or illustrate aspects of recent market action on their favorite stocks with meme videos and meme images, and they sort of promote and entertain and other people that are interested in following these stocks with memes, and that kind of generates excitement and interest around those stocks and helps contribute to their success. Although, as many people who have been on WallStreetBets for long periods of time could tell you, like, just because something is a meme stock does not guarantee that it's always going to be successful in the marketplace. And the meme smiths of the internet are just as happy to make memes, illustrating the fall of a stock in a bearish marketplace as they are in cheering it on in a bull run.
So in a way, memes are sort of a method of communicating about a stock.
Yeah, they're just something that sort of has arisen. Memes permeate many different internet-based communities, and it's, a very sort of easy way to share and entertain others who are interested in these things on social media hubs.
Sure.
Because memes are part of internet cultures, they're going to also be parts of internet cultures that are interested in markets and stock trading and YOLOing their life savings on a single stock bet, if that's what you're into, but memes are here to stay in the 21st century, and that's why you now have meme stocks, because you have with increased access for the younger generation to participate in the markets. When they participate in the markets, they're also going to make memes about it, because that's what they do. They make memes about everything.
I think it's remarkable that we're kind of living in a world now where you had two different billionaires on Twitter, and in the case of Ryan Cohen, adding $4.4 billion of value into the company. And then there's the other case of Elon Musk, who was in a Twitter conversation and said something about ETH and Bitcoin being a little overvalued. And in the same amount of time, $15 billion vaporized, into thin air. It just disappeared off the value of his stock. And what do you think's going on there?
Well, people are maybe concerned that these billionaires on Twitter are having outsized effect on market prices with their tweets, and they need to be more responsible with they need to be careful about what they say, because it can move whole markets. And I think, really, if we have a well-informed understanding of where the world is going in the 21st century, we should expect this. I mean, we're moving into a world where communication is easier and more accessible to wider audiences, and it can happen instantaneously, and the spread of information around the globe happens much, much faster today. And the fact of the matter is that if you're a billionaire, then you have an outsized ability to affect facts in the world and the state of affairs in the world. And that includes all kinds of states of affairs, which might affect investors' opinions about the values of various securities of all types. So we should expect that markets will move more than they have in the past upon the communication of opinions or statements by people that have enormous amounts of power, and having enormous amounts of money grants you enormous amounts of power in the world today, and pretty much throughout the course of history. If you've got a lot of money, you can have a lot of influence.
And you also have these kind of instant platforms. You have Twitter. You don't have to wait to go get an interview with a newspaper or
you wait for them to publish it,
write a letter to the editor. Yeah,
exactly.
You
this
have
stuff
your
is
own...
this information is available instantaneously for free to the whole world.
But the fact that you're also a billionaire and you already sort of have a profile, a certain profile at a level that instantly inflates that platform. It's a much bigger platform for you than it is, say, for you or me. If we get on Twitter, I don't think anybody reads anything I write.
The markets aren't going to move if I tweet something,
right?
But we should expect that. I don't have a big Twitter presence, so, but people that do will be able to do that. I think it's probably worth looking into some specific guidelines, because we don't want people to literally be manipulating price markets through what they say, but we also can't constrain their ability to freely communicate and express themselves. And again, we should expect that that the communication of information from those people is gonna have effects on people's opinions about what things are worth. And if you have a different opinion about what something's worth than the market does, well, too bad. There's another thing I'd like to say about meme stocks, though, which is worth mentioning, because these have had a lot of attention in the media, especially in the past couple of weeks. Alongside GameStop, you've had other securities that the media has been saying that the Reddit horde is following this meme stock now or that meme stock, and these have included a number of different companies.
It's like AMC, it's Nokia, it's BlackBerry, it's Rocket Mortgage, it's
Cost
Sundial,
Headphones, Tanger Mortgage, I think, is the newest entry into this.
But I think it's, and you mentioned this earlier in the interview, this exact point, but I think it is worth mentioning something we didn't talk about earlier about that, which is that none of those have really stuck around. AMC is kind of lingering around there, but it's not that exciting. It's only at I think $8 a share or something like that. It's not like GameStop in the hundreds.
In my opinion, the GameStop situation is unique and it is in a category separate from any of those other meme stocks you've seen discussed in the media, where it is a perfect storm that has created the situations that retail traders on WallStreetBets identified and moved into positions to strategically punish short sellers of GameStop stock in order to make themselves a fabulous amount of money if a short squeeze happens. That's a very sophisticated trading move, and I think you're finally going to start to see the media recognize that this is not a mania, that this was a very sophisticated trade executed by retail traders and ongoing. And the conditions for that are just not present in any of these other stocks. And that same play can't be replicated. And it won't ever be replicated again, I don't think, because I don't think any institutional investors are going to allow themselves to get caught in a position like that by retail traders going forward from here. But I also believe that there is a high likelihood that the traders who were the target of the retail traders on WallStreetBets are still very much in trouble, and we may see them punished in their pocketbooks going forward. That's still a very live possibility, and that this is This is not over. But that situation doesn't exist in any of the other meme stocks. And I believe they're all just sort of distractions that are probably actively promoted by institutions that have short positions in GameStop and stand to lose money there, and are actively trying to draw retail capital into other meme stocks to soften the damage they're going to take on the GameStop trade.
So I think, the GameStop trade, I think it would be fair to characterize it. Maybe you can totally disagree with me if you want to, but I think we can fairly say that this was a disruptive moment in the market. It
yes.
Definitely, in the sense that it rocked the status quo pretty hard.
And
actually.
It was in so many ways, it's an event that has been unprecedented in stock market history. Short squeezes haven't been unprecedented in stock market history, but this kind of sophisticated trade being executed as successfully as it is being executed by decentralized retail traders is truly historically unprecedented.
So what is the disruptive mechanism? Is the disruptive mechanism, is it this new accessibility?
Disruption is a very sort of en vogue concept,
sure.
Especially in the investing world these days. And I think there's no question that with the rising rate of technological advancement, you're seeing more and more disruption happening faster and faster in the world today, compared with, the further back in history you go, the longer it takes for a new paradigm to get overturned. But the technological advancements that we make over the historical timeline compound upon each other, enabling us to make newer paradigm shifts and discoveries faster and faster. And this increases the rate at which sort of disruptive events happen, and the amount of disruption that is present in the development of new technologies, and how those technologies transform all of the different sectors of the economy. So, given the popularity of disruption, it's worth noting that, why is disruption so popular? Well, when paradigms get overturned, that creates a lot of volatility, and there's a lot of change. And as anyone who has studied the best traders and the history of the stock market can tell you, volatility, while it can increase risk, it also presents, for those people who make profitable trades, fortunes can be made and lost at a much bigger scale in environments of increased volatility. Volatility provides opportunities to make very, very profitable investments. But it's worth noting that just as disruption, with the rate of technology going the way it is, it's hitting every sector in the economy. Disruption also has come and is currently reshaping the markets and the whole trading sector of the economy as well.
And I feel like that sorry to cut you off, but I feel like that's coming through the accessibility question. That's the place where it's happening. It's happening because you have increased accessibility with commission-free trading on your phone. It's in your pocket. You can start trading on the stock market for like $20, even less. You can start trading.
Yeah.
You can
fractional
buy fractional
trading
shares.
has become a thing. And so
Exactly.
this has given avenues of participation to retail traders that have at levels that have never existed before. And there should be no surprise that is going to change the game in ways that break old models. And it should also be, it's not just the increased access, but it's the increased access of a legion of retail traders that also have access to 21st century communication technology and social media, in which they can instantly and freely share ideas and information that is relevant to their opinions about when and how to trade, at levels that have never been before seen in history. And that gives them weapons in their marketplace battles, for, to win the profits that they just didn't have before. And that's going to change the game. And we're going to see things that happen in the market as a result of these disruptions coming through the stock market itself too. And with the rise of things coming down the pipe, like decentralized finance, where we're going to there's going to be alternative investment paradigms where there's no central authority, but just algorithms that have a set of rules that automatically and guaranteed make everybody play by the same rules, whether they like it or not, which is not a condition that currently exists in today's investing marketplace, as I think some of the events related to the GameStop saga have put a spotlight on.
So it's not just accessibility in the sense of being accessibility to the market. It's also accessibility to the information that helps you navigate the market.
That's exactly right. And you have,
and then you have kind of filtration systems. Sorry, but you have ways like on Reddit, things get voted to the top. The best ideas get voted up to the top of Reddit, in theory.
Yeah.
So there's even ways like on YouTube and Reddit where it'll help you disseminate what's a good idea from a bad idea. And that is increasingly becoming more and more sophisticated.
And again, it's worth mentioning while you're talking about that all sounds very exciting. It's also worth mentioning that there's a lot of terrible information out there on the internet too. And like, just because you encounter some information on the internet, that doesn't make it likely to be true. And more than ever today, it's important to arm yourself with a solid foundation in critical thinking education so that you can sort through the ever increasing amount of bullshit information that's present in today's media landscape, and inoculate yourself against that. But it's also true that if you can do so, this enormous body of information, there's ever more sophisticated ways of picking out the gems and separating the wheat from the chaff, and that's the tools for doing that are becoming more and more sophisticated and more accessible to more and more people, and that's going to change the way things work and the patterns of how things happen as you go forward. So that's going to maybe upset a lot of people that have been playing a 20th century game for a long time, and that's what they're really good at, and don't necessarily stand to be in a better position by these changes happening. But as always, with the law of the jungle, you got to adapt or die. And if the conditions change in the market or anywhere else, if you can't succeed in those conditions, well, then others will. And that's always been a part of life, as well as a part of investing and trading, and many other contexts to which that sort of evolutionary model applies.
How do you think retail investing is going to evolve now in the next, let's say, just 5 to 10 years? Do you think it would be safe to say that the retail investor maybe has a little more power in the market than they used to? Maybe the dumb money isn't going to be as dumb anymore.
I think that one of the sort of really interesting and notable things about this GameStop trade that's been going on is that it is shown that retail traders are not idiots and can in fact recognize some very, you know, interesting and obscure opportunities to profit on certain transient market conditions that require incredibly sophisticated analysis to recognize and appropriately strategize to take advantage of. And I think that the suggestion that retail traders could have done something like this, if you were to say something like that 10 or 20 years ago, like Wall Street would have laughed at you if you told them that some, you know, average just guys and gals out in the general public were gonna bleed some Wall Street hedge funds that were in a big short position for billions of dollars. They would have laughed at your face and said, that's never going to happen. And that's one of the reasons I think that this is such a historically interesting event, is how it is shown that what retail traders in the 21st century can be capable of. And, you know, obviously, how this plays out won't entirely be up to the retail trader. And while they might have a more outsized influence than they have had historically, they're probably, you know, still, it's still kind of a David versus Goliath story in any time you have retail investors on another side of a trade from Wall Street institutions. Those guys have a lot of capital to invest and a lot of sophisticated tools for understanding the market and achieving their goals. So retail investors should probably not get too cocky, but maybe neither should Wall Street institutions these days.
People are talking about stocks right now the way that people normally talk about sports. That's sort of the way I see it. Like when I walk into work now, my colleagues are like, "Oh, did you guys see what happened to Cardano today?" Or, you know, "Did you watch that Apple stock?" Like, or they're talking about the GameStop trade, almost like they talk about like a sports team. And people are whipping out their phones and like showing their portfolios, and I've never seen anything like that before. And to me, that's something that is completely unprecedented. It's like the stock market as a very viable form of entertainment.
Obviously, the comments that I've just made over the past few minutes would suggest that we should expect going forward a influx of interest and participation in markets by retail traders, just by the nature of the sort of technological disruptions that provide those traders access to markets. But it is also worth considering an alternative view, and one that is maybe a little more of a potential warning, which is that it is not the case that there have never been periods in history where you've had a massive surge in retail investment and interest among ordinary, usually non-investors getting involved in marketplaces.
That is not unique.
It's not unique, and the bad news is that the times in history that happen usually are right before there are big corrections or even crashes in markets.
But see, now we're in a situation where we have this kind of entry into the market like this, but unlike the past, people have direct access to the market and they have it in their pocket.
That's true, but considering the alternative view here, Mike, it's perhaps you've heard the shoe shine boy indicator. There's a famous anecdote about John F. Kennedy's father, who was, I think, a Wall Street banker.
Joseph Kennedy.
He was on his way to work one day, and the stopped to get his shoe shine on the street, and the shoe shine boy was like, "Hey, let me give you a tip. You should buy stock in Hindenburg." And the Joseph Kennedy then went on to his office and proceeded to close out all of his positions in the market and sell all of his stock. And about a week later, the great crash of 1929 took place. And he, in subsequent interviews, said, when the shoe shine boy on the street is giving you stock tips, like, you're at the top. It's time to get out. And it's worth pointing out that there's generally a pattern in which, the stonks can't only go up forever, right? Because the stocks continuing to rise and continuing means that there's more buying. And eventually you hit a point where if everyone is talking about buying into stocks and everybody's buying into stocks, then there's nobody left that can buy into stocks after that, and the market is saturated. And this is actually related to the smart money, dumb money dichotomy. That's, it's often they get criticized for pointing out or calling retail traders dumb money, but the reason they do that is because it's part of describing this pattern in which institutional investors get involved in a particular bull market situation, and as it goes forward, people see other people making money and they jump in and they buy, and the price keeps going up until once everybody's bought in, though, there's nobody to buy in after that. And at that point, the smart money then exits the market, and all these new guys that just came in, hey, everybody's making money. And then the market falls out underneath them. And in a classic pattern, the dumb money, the retail traders that just got excited about investing and rode in on this huge popular wave, get wrecked, because then the market corrects. And I think you're actually just starting to see the beginning of that kind of movement in the market now. So I'm not advising anybody about what they ought to do with their investments. You need to do your own research, but it's worth considering both sort of opinions or directions that the market might be heading in, and the different cases for each of those. And it's not unreasonable to think that a widespread interest in the market by retail traders, even in a situation where that's sort of amplified by technologies that increase access, that may still be an existence of a pattern that may repeat itself once again. And we certainly have been in a very bullish market since the dip last March due to the oncoming pandemic, but the market has recovered from that to levels that it was at pre-pandemic and soared even higher. And somewhere there will be a limit to that upward movement. It might not be right now. It might be down the road sometime. Typically, trying to exactly time these things is next to impossible. But you can bet your bottom dollar that someday it will correct. I'd also just like to say one other thing with respect to the GameStop situation, and that's that if indeed the price of GameStop begins to rise dramatically going forward, it's going to tempt a lot of people to jump on board thinking that they're going to make a quick and easy buck on this. And I would urge people who are not, haven't looked at this in great detail and understand that there's sophisticated strategizing in ways that you wouldn't normally approach a regular trade. I truly believe that this is a unique trade among any other typical investment situations. And if you're jumping in to try to make a quick buck, but you don't understand what's going on, you're likely to end up getting wrecked, and you may indeed also mess things up for other people trying to effect a sophisticated trade. So I plead with listeners who may be excited about that, if that happens in the future, to not jump into it out of excitement or mania. If you're interested in trading that, please study up on what's going on with that and make your decisions from an informed perspective and not based on pure excitement and emotion because you see a rapidly moving price in a stock. So that is the thought I'd like to leave our listeners with today.
Say no to FOMO.
Say no to FOMO and do your own due diligence. Do the research and understand what you are investing your money into and have a plan.
Justin, you are always full of fascinating ideas and fascinating information. It's truly remarkable that you have been following this story. I'm so happy you've been following it with laser-like focus, and I insist that you come back on again and do a third episode with me and we can talk about this.
So be it.
Justin, thank you so much.
The pleasure is mine.
Everyone, you've been listening to Interview Time.